Hey everyone, today we're going to break down something that's at the heart of all business, the golden rules of accounting. These aren't just boring regulations, they're the secret sauce, the fundamental logic that makes all of a company's finances actually make sense.
But let's start with a quick question. Do you think a company's profit is just, the cash it has sitting in the bank? It feels like it should be, right? More cash in the bank, more profit. Well, you might be surprised to hear the answer is a big, fat no. And understanding why is kind of the key to unlocking this whole thing.
So, to really get that answer, we need to stop thinking of accounting as just complicated math. Think of it more like a game with a very clear, logical set of rules. And once you get the rules, every single move just clicks. It all makes sense. Okay, let's dive in. First things first, we've got to define the playing field. Who are the players and what are the basic ground rules we all have to agree on before the game can even start? Rule number one is the business entity concept. And this one is so important. A business is its own person, financially speaking. It's totally separate from its owner. So if the owner goes out and buys a fancy new TV for their living room, that is not a business expense. The company's wallet and the owner's wallet are in two completely different worlds. Period.
Next up, we have the going concern assumption. Basically, we play the game assuming the business isn't about to go belly up tomorrow. And this is a huge deal, because it completely changes how we value things. If we assume the company's going to keep going, its delivery van is a useful asset for the future. But if we thought it was about to liquidate, well, then that van is just worth whatever we can get for its scrap metal. See the difference?
All right, so the playing field is defined. Now for section 2, how do we actually keep score in this game? What are the actual mechanics for tracking every single thing that happens with the money?
There's a pretty simple 4-step logic to it. First, we need a common language to measure everything. Then, we have to chop up the life of the business into shorter game periods. Next, we record stuff right when it happens, not just when cash changes hands. And finally, we have to connect our costs directly to the results they produced. Let's break each of those down.
So, that common language, it's money, of course. This is the money measurement concept. What it really means is that if you can't put a reliable price tag on something, it doesn't get recorded in the main financial books. Think about it. A company could have the most amazing, creative, skilled team in the world, but you're never going to see awesome employee skills listed as an asset on their balance sheet. Next, a business could be around for 50, 100 years. We can't wait that long to see how it's doing, so we have to chop its life up into manageable pieces. That's the accounting period concept. We create these artificial time slots, like a quarter or a year, to stop, take a breath, and ask, all right, how do we do in this specific period? Okay, and here it is. This is the big one that answers our first question. It's all about when we record things. It's called the accrual concept. It means we record revenue when we earn it, not when the cash finally shows up. So, if you finish a big project for a client in December, you record that income in December, even if they don't get around to paying you until February. And that brings us perfectly to the other side of the coin, the matching concept. This is just pure logic. To figure out the real profit for a period, you have to take the revenue you earned in that period and match it up with all the expenses that you had to pay to generate that revenue in that exact same period. So we've got the field, and we know how to keep score. But what about a referee? Section 3 is all about the principles that make sure everyone plays fair and that the final score is actually something you can trust. First up is the consistency principle. And this one is pretty much what it sounds like. You can't keep changing the rules just to make yourself look better. A company has to use the same accounting methods year after year after year. That's what lets investors make real, meaningful, apples-to-apples comparisons of how the company's doing over time. And then there's this really interesting one called prudence, or as a lot of folks call it, conservatism. Just think of it as the play it safe rule. Accountants are supposed to anticipate and record any potential losses as soon as they seem possible. But potential profits? Nope, you don't record those until they're a done deal. Now, on one hand, this stops companies from getting ahead of themselves, but it also creates this fascinating gray area. Clever managers can sometimes use this rule to manage their earnings. Maybe they recognize a bunch of potential losses in a really great year just to make a future bad year look a little bit better. It's one of the big reasons you really have to read financial statements carefully. Okay, on to our final section. Let's pull this all together and look at the final scoreboard and really see why any of this matters out there in the real world. Look, the whole point is that these principles aren't just abstract ideas for accountants to argue about. They are the absolute bedrock that makes financial statements reliable, comparable, and realistic. Because everyone's playing by the same rulebook, you, as an investor or just an interested person, can look at a report and actually trust that it's a fair picture of what really went down. Let's put this to the test with a super simple, real-world scenario. Imagine your company gets its electricity bill for the month of March. You used all that power to keep the lights on and run the machines for the entire month. But here's the catch. The bill shows up on March 31st, but you don't actually cut the check and pay the power company until sometime in April. So here's the question. According to the rules of the game we just learned, is that electricity cost a March expense or is it an April expense? What do you think? The answer, it is 100% a March expense. And why? Because of those two powerhouse rules we talked about, accrual and matching. You incurred the cost in March, you used that electricity to help you make money in March. So to get a true picture of your profit in March, you have to match that cost to that month, no matter when the cash actually leaves your bank. And that really brings us to the most important thing to take away from all this. It's not about memorizing a bunch of rules. It's about understanding the why. Once you get the logic behind the rules, every journal entry, every report, it just clicks. It becomes logical, not just something you have to memorize. So I'll leave you with one final little brain teaser to make sure it sticks. Using these same principles, why is an employee's salary that they earned working in December but won't actually get paid for until January, why is that still counted as an expense for the company in that December year-end report? Think about the rules we just covered. That right there, that's the logic of accounting in action. Thanks for joining us.